In this video, I'm going to talk about how I've been able to predict the markets constantly using a liquidity-based approach and getting insane accuracy. So in the past week, I've been talking about this key level here at 27,350. Now for me, this was a key level using my liquidity-based approach. And so a recap of this is as soon as we worked out this level, immediately had our decline to our lower liquidity levels. And so if we go up here in my group, this is a free Telegram group in my description. I gave all the analysis for free on why I think this is going to happen and how it's going to happen. So initially we were expecting a move from these lows, from this liquidity sweep up into this 12-hour block, up into this 12-hour zone. Now once we had that move, I was then expecting a drive lower. And so as we can see, that has happened exactly as planned. So the thing about liquidity is the market is always drawn to key liquidity levels. The market will only go up if there's a key liquidity level above, and the market will only go down if there's a key liquidity level below. And what the market tends to do is create, the standard uptrend, the higher high and higher low. A lot of people will think that this is a break in structure, change in trend, and we go lower. But it's simply just a liquidity sweep of a key level for us to continue higher and go beyond. And so this is why I don't use support and resistance patterns or any of that, because it doesn't quite make sense. Because I can draw a line anywhere on this chart as I did here. And I just drew that randomly, and you can see that it was resistance here, it was resistance here, it was support here, support here. So you can basically draw a line anywhere on your chart, and at some point in time it'll be support and resistance. And if I just drag that out, we can see that it was support here, flipped it, became resistance, and it gives you no gauge on where the market will go. But using a liquidity-based approach, once your liquidity is swept on the bottom, we target liquidity on the top. Vice versa, once liquidity has been swept on the top, we target liquidity on the bottom. And so you can use a time frame based approach where you initially look at the weekly, figure out your liquidity points, your daily, and your 12-hour, and so on and so forth. So you just go down into your time frames and scale in. And I like to stop around the 4-hour time frame because that gives me my kind of key liquidity levels for the week and what I think is going to happen. And so for me, this was a key 4-hour level for me. And so when we're up in this range up here, I was potentially expecting price to come lower into this liquidity level, wick up, and then roll over. But we didn't end up coming down into the key 4-hour level. We ended up coming down into key 1-hour level, which was right here. Now I'm not going to go into depth on why these are key liquidity levels. If you want to find out more, there'll be a free Telegram group in my description. Feel free to check it out. It's definitely worth it. It's all for free, and I'll provide daily analysis of what I think is going to happen and where the market will go. And yeah, it's a very straightforward approach. It's very easy to understand. Most of my charts are going to be arrows or just price predictions, such as this. So if you're new and you don't know much and you like what you see, check out the link in description. Cheers.